was 2008. I wanted to sell commercial real estate, but this is not the right time to get in the industry. The whole market was coming down. I found myself on a car lot wondering, what am I going to do with my life? I could be 80 years old one day, laying in my bed, staring at the ceiling, kicking myself because I never fucking tried anything in life. How about that risk? Most successful real estate investors got really good at one thing before they started doing multiple things. But in today's climate, you got to buy at a discount, you got to be able to add tremendous value to have that cushion, that margin for error. And so that's what I'm looking for right now.
What Rich just talked about is what changed my whole perspective.
We know we want to build a big thing with Somers Capital. And so we want to buy $1 billion worth of real estate.
Welcome to the show, Rich.
Jeff, pleasure, man. Thanks for having me up here. It's a pleasure kind of touring your facility, man. Very inspiring. And dude, this studio is magnificent. This is the nicest studio I've ever seen, man.
Well,
Congrats.
Thank you. I took inspiration from some other studios that I got to be a guest on. And, when you build your own, you always want to make it perfect. And it was important for us to create a space that allowed us to create incredible content, bring our guests into an ecosystem that made them feel great, and provide all of you real good value.
Yeah, absolutely. Well, you were on my podcast 2 weeks ago, and I was telling you how I was inspired by seeing Ryan Pineda's new studio. So I was going to do some upgrades, but you're like, hey, wait till you see mine. I'm like, I'm so glad I saw this first because there's a lot of good ideas in here that I'm gonna implement.
Well, when it comes time, as I mentioned to you, we're happy to try to help you bring that inspiration to reality, or at least give you some ideas.
Yeah.
It's all about, I hope yours is better than ours. And if we all keep one-upping each other, then great things come at the end.
That's the name of the game, healthy competition.
That's right.
Yeah.
That's right. Well, thank you for coming and doing my show. I really appreciate it. Your story is awesome, from air traffic controlman to real estate empire. But I have to ask, so you did air traffic control for 11 years.
11 years, man. I was taught from a young age to go to school, get good grades, go to college, get a job. And for the most part, that's what I did. And I got into sales out of college, or while I was going to college. I sold cell phones. And then I went on to sell cars. And that was my first taste of what it was like to kind of control your paycheck to a certain extent. And I got out 2008, a school actually not too far from here, Cal State San Marcos. And it was 2008. I wanted to sell commercial real estate. And I interviewed at a couple brokerages, CB, Richard Ellis, Grubb & Ellis. And they were like, hey, we love your hustle, but this is not the right time to get in the industry. The whole market was coming down. I found
2008.
This is 08.
Yeah.
I found myself on a car lot wondering, what am I going to do with my life? And I stumbled across a job as an air traffic controller and took it, ran with it. I loved it, did it for 11 years. But along the way, I remembered real estate and I was like, dude, I got to figure this out. And that's when I got really heavy in the real estate investing, and I cashed out my 401k, and that was my seed money to do my first couple of deals.
Now that we just jumped from deciding to cash out to do it, but that's a big decision. And I think a lot of people get stuck because they've been doing something for 10, 11 years. Yes, their dream is something else, commercial real estate or real estate, but they get locked in to realize that they've built this life, they've built this entire ecosystem around them based on that paycheck in air traffic control or whatever it is, based on the stability that provides. But you said, hey, I'm ready now. What was the impetus? What made you make that decision when you made it?
Yeah, so I was actually in the break room between controlling airplanes, and one of my coworkers at the time, I overheard him saying that he had just bought a fourplex in Cleveland. And I thought it was the coolest thing ever. And I was like, dude, how did you do that? And he's like, hey, go read this book. It was the blue book from Brandon Turner, Investing in Real Estate Investing. And read the book, devoured it, and then I started listening to podcasts. I started reading books. I started going to networking events before I ever owned any real estate. I just became obsessed. So for about a 9-month span, I stopped going out. I was working 56 hours a week with my air traffic job. Every single hour outside of that, on my way to work, on the way home from work, I was literally just studying. And 9 months in, I was like, okay, I got to take action. And so I found my first deal. It was an 11-unit apartment building in Cincinnati. And I knew I was going to go for it. Decided to cash out my 401k. But to your point, it was scary, that first deal, because everyone, friends, coworkers, even family members, told me it was too risky. They would be quick to outline all the risk. And I'm just so lucky that I did not listen to all that noise. And looking back, like my takeaway is this. All those risks that people allude to are real, so put some weight on it. But on the other side of the balance scale is another risk, and it's this. I could be 80 years old one day, laying in my bed, staring at the ceiling, kicking myself because I never fucking tried anything in life. How about that risk? That's a risk that a lot of people don't allude to.
Mm-hmm. And you said your first deal was an 11-unit apartment complex?
Mm-hmm.
Most people start with a single family or a duplex. 11?
11 units, yeah.
So you really listened to Brandon Turner's advice.
Well, it's funny because, like, you know, I was reading all the stuff, and for whatever reason, multifamily kind of just like it just drew my attention. And the more I like started listening to multifamily content, people are like, "Oh, just skip the single family stuff." And so I went to Cincinnati because it was like that was the most bang for my buck at that time, and it was like a higher cash flow market. Today, my perception has changed. I'm going into high growth markets, but it was a good area to like do the first couple deals, get my feet wet. You're not going to lose any money there. It's hard to like really make a big mistake there, but it got me in the game. It got me the confidence to do the next deal. You know,
Do you still own that 11 unit?
I still own it today. So I bought that thing for $350,000,
In
which
what
is
year?
crazy. This is 2019.
2019.
2019, 11 units. It had all the deferred maintenance. I made all the mistakes. I hired the wrong property manager. But a couple years later, refied that thing, pulled all my money out. And that thing still today pays about $2,100 a month in passive income. And it's worth about like $850 today.
Did you refinance it when interest rates were at their bottom?
I refinanced it when interest rates were still low. So that was nice.
So how do you refinance in the future if interest rates don't come back to that low number?
Yeah. So actually, we just refied a couple larger deals. And so these are a couple larger deals out in the North Carolinas. And we picked them up in 2021 on floating rate debt. And that was where all the smart money was going in 21 because rates were 2.5%. And so this was a 150-unit townhome style community called Timber Creek, and another one that we acquired 3 months later called the Arbors. And both of these apartment buildings we bought on floating rate debt.
What is floating rate debt?
So floating rate debt is adjustable rate mortgages. And so when you go buy these larger apartment buildings, Fannie Mae and Freddie Mac will finance non-recourse for multifamily. And at the time, with the adjustable rate mortgage, this program, all the smart money was going there because the prepayment penalty was only 1%. So if you're going to buy a fixer, and you're going to add a ton of value, and hey, I'm going to refinance or sell this property once we add all the value, it's nice to have a very low prepayment penalty. A lot of these commercial loans will have very expensive prepayment penalties. Depending on the size of the loan, it could be a $3 or $4 million prepayment penalty just to get out of the loan. And so with the 1% prepay, that was where all the smart money was going. And you're seeing a lot of people get caught right now because no one anticipated the rates would go up this high. So both of those deals, we got them with about 2.5% floating rate debt, which sounds great. And you would hedge your risk with a insurance rate cap. And
What does that mean?
So basically, an insurance company will ensure that the rates will not go up X amount. So we'll buy a rate cap. You'll have to prepay for it to get the loan. And the rate cap is 200 basis points. So if the intro rate's 2.5, the insurance company says if the rates go up to 4.5, we got you. You're not going to come out of pocket.
4.5.
Yeah, up to 4.5. Now, if it goes above 4.5, which it did, now you're going to come out of pocket. And so both of those deals, the debt service went from mid-20s a month, $20K a month, to about $80,000 a month. So there goes all your cash flow to the investors, right?
Yes.
And so
potentially you're upside down on the entire property.
Potentially, yes. And so we were fortunate enough on both of those deals to where we had to make a decision. We had to stop distributions to the investors in Q4 of 22. And we had to make a decision. Do we keep rolling with this floating rate debt and hope that interest rates go down? Or do we refinance into fixed 5.5% debt and then be able to do distributions again? So luckily for us, and a lot of other operators are not in this position, we were able to add enough value through our renovations and the rent increases to where we could refinance into the long-term debt, even though it was more expensive. In one of the deals, the Arbors, we did a cash out refinance. We returned a couple million back to the investors. And then Timber Creek Apartments, we were able to refi, but we didn't have to bring any cash into the deal. Now, there's a lot of news and volatility in the marketplace right now. There was an article that came out recently in The Real Deal a couple weekends ago. There's someone in Houston who's getting foreclosed on a $51 million multifamily loan. He picked this up in January 22, right before the rates went up. And, unfortunately, he was not able to increase the NOI enough to refinance the fixed rate debt. Went back and forth with the lender, tried to negotiate something. The lender's not willing to negotiate. And so they're foreclosing on a $51 million loan, and all those investors are going to lose their money.
Wow.
And so, unfortunately...
He doesn't want us to try to just sell it?
Well, he can't sell. He can't sell because he bought at the top of the market, wasn't able to increase the NOI. Now the rates went up. And so now that next investor who could potentially buy that apartment building, because of the rate environment has doubled, is not able to pay the same price that he paid a year and a half ago. Mm-hmm. And so they're not making the cash flow to pay the debt service. And so unfortunately, there's operators out there right now that are in that position. So it's going to be interesting to kind of see how this navigates. Grant Cardone was on my podcast recently, and he bought almost $1 billion multifamily portfolio at end of 21, all on floating rate debt. His debt service has tripled since then. And so he's funding those deals right now, the debt service, with his own money. And luckily, a guy like Grant has a lot of other streams of income. He can do that. But
if it goes too long, he can't do it forever.
No, nothing's forever. And so,
what does a guy like Grant do?
He's going to hope that rates go back down. And I'm kind of in the same boat.
Is hope a strategy?
I know, right? If I'm a betting man, though, I would say a year from now, I'd be shocked if the rates are where they are today. I think they're going to I don't think we're going to see 3% rates again for a while, but I think they'll normalize somewhere around 4.5 to 5.
And is that survivable?
What do you mean when you say that?
For all the people who bought in 21 and 22 when interest rates were 2.5%, 3%, money was free.
Mm-hmm.
The market was at all-time high. If we normalize back in that 4 to 5.5% that you just said, does that allow that group of people to survive?
I think it really depends on a couple factors. So one, I think it depends on when it will normalize. With where rates are today in this very moment, I don't think it's going to – if it goes past a year, it's going to be tough, right? But the other variable is this. There's a lot of – whenever there's a gap in the marketplace, so like right now there's a need for secondary lending, and there's a lot of operators that are in trouble. And so it depends on how many other lenders are going to come to the group. There would be like private groups that go, and I know a few that are doing this right now, and they are going to go attack that gap in the marketplace. They're going to provide lending. It's going to be at a cost, but they're going to come in and save some of these operators, but they're going to take equity of these deals. They're going to take control of these deals, but at least these deals won't go to foreclosure.
Which saves the investor, saves the operator. They take a haircut, but they don't lose everything.
Exactly. And so that will be one savior with the real estate economy, if you would. So we'll see. And we'll see how many of those groups are going to come in and fund some of these deals. With this one that's getting foreclosed on in Houston that I just mentioned, the $51 million loan, that one's not going to be saved. So we'll see how many more of those there are. Obviously, once those start to surface, you're going to start to see some discounts in the marketplace. But it's important to remember, I think, right now, the fundamentals behind real estate in most markets are very good. So there's a supply and demand, basically a shortage of supply to meet the demand in most markets. There's a shortage of housing, and there's also a shortage of apartments to rent. And if you look at the demographics right now, they've never been stronger. You got the baby boomers who are living longer. They're not going into retirement homes and selling their homes at an early age anymore. They're living longer. And then you have the millennial generation who is buying their first homes. They are starting families. And then you got the Gen Zers behind the millennials, which are even bigger. They're moving out of their parents' house for the first time.
Bigger as in more of them?
Yeah. They're moving out of their parents' house for the first time and renting apartments. And so from a demand perspective, it's never been stronger. And the affordability has been a thing. We all know this. If you look at, housing prices over the last 40 years, they've gone up like 10x. But if you look at the median salary and the median household income over the last 40 years, it's only gone up like 2x. So there's a big affordability issue. And in order to, solve that, we need to build more housing. And what the rate environment is doing right now is it's creating a pause for new building because builders don't want to build right now with the higher rates.
Because materials are expensive.
Materials are expensive.
Loans are expensive.
The holding costs are more expensive, so there's a lot more risk. And then, also, if you say, okay, well, the rate environment's high, the likelihood that real estate's going to continue to go up over the next 18, 24 months is a lot lower, right? And so the return profile goes down. There's more risk, so a lot of builders are being hesitant. You're seeing building permits are going down, and that's not solving the long-term affordability crisis. Nationwide, most markets.
Wow.
So I think when rates do normalize, you're going to see another run. I mean, there's going to be a lot of demand. The faucet's going to be on, and it's going to be tough to get deals again.
So let me ask you that, though, because I read something that the reason there's no supply is also because, and I'm going to butcher the statistic, but it's somewhere high. Like it's around 80% of all mortgages in the United States are under 4% interest rate. Like all of them. Everybody, 80% plus refinanced when we had low interest rates, cheap money. So now everyone feels like, well, why would I sell my home? Even if I want to downsize, it's going to cost me more to downsize with this interest rate environment. So I'm going to keep what I have, and I'm going to keep my locked-in low interest rate. So I read this report that if interest rates come down, you've now freed up 80% of the market who may want to move, who may want to sell, to be able to finally do that, and that will then put a supply shock to the market because now everyone has the freedom to move. Where right now, to your point, there's no supply because I can't sell a $1.5 million or $1 million piece of property at 2.5% interest rate.
Mm-hmm.
Even if I want to buy a $700,000 property and downsize at a 6 or 7% interest rate, I'm going to pay more for it.
True.
So do you think that's going to create that supply shock? Do you think the low interest rates may not make us get another run, but potentially put an oversupply into the market?
It will definitely increase the supply or the deal flow, if you would. However, it will also create a lot more buyers because now all those buyers that have been on the sideline and they can't afford that $700,000 house at 7% rates all of a sudden can. And so it will take a lot of those folks that are maybe living at their parents right now saving, or they're living in an apartment building right now saving to when the rates go back down. Now they're going to enter the market and they're going to be buying a lot of the product out there of the sellers that are looking to trade up into larger properties. So I think it'll be a good thing, especially for the brokers out there, the real estate agents, the lenders. It's been a tough 12 to 18 months for them.
Yeah. Knowing what you know, if you were sitting in your air traffic control job today, but you're ready. You spent the 9 months. You're ready to make that pivot from air traffic control to real estate. What would be your first deal you'd be looking for today?
Ooh, that's a good question. So I think what I would do, and this is probably the answer for most folks, is I would go buy a fourplex on an FHA mortgage, 3.5% down, go buy a fourplex, live in one of the units, and rent out the other 3. You don't have to live there forever. Live there for maybe a year, but you're going to get a lot of experience. 1, it's going to get you in the game. 2, it's going to teach you how to manage some tenants. You're going to have some flow coming in. You'll likely live for free because the income of the 3 units will cover your living expenses. You're going to get some tax breaks. You're going to get some cash flow. And then in addition to that, take all that money you're saving, because for most people, your housing expense is the most expensive thing. And then take that money they're saving and start saving it for the down payment for the next deal. Once you go buy the next deal, maybe rent out that unit you were living in, and now you got this fourplex, 3.5% down, and over time, that thing will pay itself down. It's going to go up in value, and it's almost the for sure way to create $1 million of equity over time, and this works in most markets around the country. Even in San Diego, you might spend $1.52 million on a fourplex, but over time, that fourplex is probably going to be worth $4-5 million one day. The debt will be paid off. You got it for 3.5% down. It's almost a for sure way to become a millionaire.
And do you believe that you should ever sell a piece of property in your portfolio? If you're not you who has obviously a fund and you have investors, but the average person watch this who wants to break into real estate, hell, me, right? I've shared with you my portfolio and my real estate side goals. Do you think it should be a buy and hold forever?
So generally speaking, the best way to build long-term wealth is to buy and hold and keep buying more. However, it really depends on the opportunity cost. And what I mean by that is this. And so if you have an opportunity that is going to create a lot higher velocity of money or rate of return, and you want to go buy this deal, and the only way you can buy it is to sell a current asset and do what's called a 1031 exchange, then it would make sense. Or another example is this. So like with our strategy is we buy underperforming assets. Right now we're buying boutique hotels. And so we're buying these underperforming hotels. We're renovating these properties. We're increasing the income tremendously over the first 18 to 24 months. And so a lot of the equity growth is in the first 18 to 24 months. And we'll look to refi and hold these things long term. However, the velocity of money is the highest in the first 18 to 24 months. And so if you strictly look at that, it makes sense for us to just increase the value, sell every 18 to 24 months, and then roll that money into another project to where we can do the same thing, rinse and repeat. So it really just depends on the strategy of you as the personal investor. A lot of folks that are not active, they want to be a little bit more hands-off. Maybe they have, a full-time career or they have full-time business where that's the highest and best use of them and their capital. Well, then maybe you do a lot more buy and hold stuff, make it more passive. And there's nothing wrong with that either.
You said velocity of money. Can you define that for us?
Yeah. So velocity of money would be how quickly you're growing or forcing equity. So in the real estate world, we like to call it forcing your appreciation, right? So with residential real estate, and a lot of folks, that are getting into real estate investing, they're not aware of this. In residential real estate, it's valued based on the comps. So whatever my condo is worth, or whatever the condo across the street sold for, relatively speaking, on a square foot basis is what my condo is worth, right? Or my single family home. Now with commercial real estate, which is a bunch of different asset classes, but let's say apartment building, for example. So, a 20 unit apartment building is not valued based on the sales comps. It's valued based on the income approach. And so the more income that property makes, the more it's valued. And so with commercial real estate, the net operating income, which is income or revenue minus all expenses, equals your NOI. NOI divided by the cap rate equals value. And so once you learn that formula, it's a magic formula, because the more I increase the income, the more I decrease the expenses, the more my property is worth, but it gives us full control. And so to answer your question, the velocity of money when we're doing these value add projects with the commercial real estate is when we're growing the income, whether it's through better operations, better marketing, renovations, and then maybe we find a way to be more efficient on the expense side, such as, let's say charging pet fees, or now we're going to sub-meter for water, which will be pushing off the water expenses to the tenants, or we're going to do solar, things like that will increase the NOI, force our appreciation. That is usually all done in the first 18 to 24 months. After that, it's like we've kind of captured a lot of that growth.
So now you're subject to just the market.
Inflation. Yeah, just natural organic market inflation and appreciation.
I really want to get into the boutique hotels because you're the only person I know doing that, and I think it's fascinating. But I have a few other questions first. What is the biggest mistake novice investors in real estate make, maybe you made, that you wish you had a bullhorn that you could say, just stop doing this?
Mm-hmm. So a couple things. One of the things that I see a lot of new investors, one of the mistakes they make is they want to get into real estate investing, and then they go to all their friends and family for advice on how to get into real estate investing. And unfortunately, a lot of friends and family that have never owned real estate are going to outline all the risks. They did it with me. And so unfortunately, I see a lot of novice real estate investors never get started because they're going to their friends and family for advice. And so I would say, go to networking events, go to conferences, listen to podcasts, and start hanging out with folks that are actually buying the real estate and go to them for advice, right? And then I would say the second thing is get very clear on your search criteria. There's 100 different ways to make money in real estate. There's fix and flip, wholesaling, self-storage, office, retail, commercial, short-term rentals. So it's like there's 100 ways to make money. You can get very distracted. So pick one early on, like pick the one that you resonate with most, and then go do a couple deals in that one space and figure out how to get good at that one thing before you move on to the next thing. Now, like once you get good at one aspect, then you can, kind of start to parlay a little bit. But most successful real estate investors got really good at one thing before they started doing multiple things. And so I would say those are the two mistakes I see.
Okay. And then my last question before we talk about boutique hotels. You mentioned that there's lots of ways to make money in real estate, but there's also quite a few ways to over leverage yourself in real estate. Is there a model that you use or you've come up with that says, this is my financial criteria that when I'm looking at these deals, and because I think what a lot of, and I felt guilty to this, novice or early real estate investors, you want to get a deal so bad that you start to tell yourself, this is a good deal, even if it's not. Do you have like a mathematical or a formula that says, if these metrics aren't there, I don't do the deal?
Yeah, absolutely. So when we're doing, now I buy all sorts of different types of deals. So we have the fund where we're buying boutique hotels right now. We have multifamily with investors. When we're buying deals with investors, we're underwriting to the investor rate of return. And so we know our investors want a 15 to 20% average annualized return, and we're going to look to get, 8 to 10% cash flow monthly, right? And so that's how we underwrite the commercial deals. Now, the deals that I do without the investors, that's a little bit different. It's my money. And so I can take a little more risk if I want to, or if I don't like a particular deal or market, like that's okay, right? But here's the other thing. So when we're doing our own deals, for me, I've learned, and this is a big pivot I had since early on. So early on, I was all about the cash flow. I was like, man, I want the cash flow, I want the passive income. It's great. Cash flow will pay the bills, but right now I'm looking for the big equity growth, especially with where we are in the interest rate environment. You're not going to have crazy cash flow anyways. And so for me to buy a deal right now, I need two things. One, I need to be able to buy at a discount. And two, I need to be able to add tremendous value. And so by buying at a discount and adding tremendous value, I know it's going to give me a cushion and a margin for error should the market continue to soften and it is going to continue to soften before it improves because of the rate environment. And so for me, like ADU play right now in San Diego is huge. It's one of the only markets in the country to where you can buy a single family home on a large lot, and you could potentially build up to 4, 8, even 10, 20 units on a single family lot because of the affordability crisis that we have here in San Diego. And so, for example, you can build right now ground up for like $250 to $300 a square foot all in. In some of these neighborhoods, depending on where you are, proximity to the beach, but some of the nicer neighborhoods might comp out at $700 to $800 a square foot.
Wow.
So you're building at 300 and it's comping out at 800. You're capturing that delta of $500 a square foot. That's massive, right? And so those types of projects I'm very bullish on in this rate environment because I can add tremendous value and then I can refi. And I don't care how high the interest rates are if I'm going to double the value of a property over a 12 to 18 month span. I can refi out, and I think come 12 to 18 months from now, the rate environment will be stabilized again. It will probably be an opportune time to refi into some long-term debt. And one thing I would say for your listeners right now is, what worked in 2015, 2017, 2019, because the market was going up so quickly, you could buy a turnkey product and just put a long-term tenant in there, or you could do the short-term rental stuff, and you're going to be fine and just let the organic appreciation of the market take you somewhere, and you didn't have to do a lot of work. But in today's climate, you got to buy at a discount. You got to be able to add tremendous value to have that cushion, that margin for error. And so that's what I'm looking for right now.
I mean, it makes sense. It makes total sense, especially in San Diego with these ADU laws.
Mm-hmm.
I mean, it's great.
Oh, it is great. Yeah. And if you live here right now, I'm like, man, that's a huge opportunity. And you hear a lot of folks like out of state, never invest in California. Well, the people that say that have never invested in California, right? But if you study like San Diego real estate and a lot of like these California markets, every 10 to 15 years it doubles like clockwork.
Mm-hmm. You think it'll continue even from where we are now?
I'm very bullish on San Diego looking forward. I'll tell you why. So they say San Diego's on an island. So geographically, to the north, you got Camp Pendleton. To the west, you got the Pacific Ocean. To the south, you got the Mexican border. And then to the east, you got mountain ranges. So from a supply standpoint, there's only so much supply to live on or build. If you look at the 4 major markets in California, you got the Bay Area, Los Angeles, Orange County, and San Diego. Out of those 4 markets, San Diego is by far the cheapest. It's the most affordable, but you could also argue it has the best climate, has the best beaches, it has the chillest vibe.
Coolest people.
And the coolest people, yes, like Jeff. And so you're seeing a lot of tech companies, you're seeing a lot of biotech companies migrate down here from the Bay Area. And so you're seeing out migration, but you're also seeing in-migration. The in-migration in San Diego right now is higher household income families, people that are spending up. And so as this continues to happen, it's only going to push pricing up, in my opinion. So I'm very bullish on San Diego long term. And then one tip I would say for your listeners out there, this is a huge opportunity in San Diego. I don't know if people were sleeping behind the wheel, but there was 16,000 short-term rentals in the city of San Diego. We manage and operate short-term rentals and boutique hotels in 10 markets around the country right now. San Diego by far is the best market that we're in. We don't need to push and pull on these listings to keep them full. From a seasonality perspective, the weather is great here year-round. And so right now this is in May of this year, they slashed the supply of short-term rentals. They started regulating them to 5,000 short-term rental licenses. And so 16,000 to 5, but there's still 1,000 licenses left in the city of San Diego. Once they're out of those 5,000, they're not going to issue anymore. And so I would say for your audience out there that's looking to do a deal, if you live here locally, pick up a piece of property here in San Diego, like a single family on a large lot where you have the ability to build ADUs, renovate that main house, get the license, operate as a short-term rental, and then take your time getting the permits from the city. It's going to take 12 to 18 months to get the permits, and then you can build out those ADUs. And now you got a property that, is hitting a few different metrics. One, it's cash flowing as a short-term rental, but 2, you're adding all this value with the ADUs, and then you can refinance a year or 2 from now when the rates are back down, when the property's worth a lot more, and now you get a nice cash flowing asset, but probably no money in the deal and an infinite return on investment moving forward.
If there's 16,000 current, or was 16,000 current short-term rentals, why didn't the other 11,000 apply for that 1,000 remaining licenses?
Yeah, I don't know. So I think either people were sleeping behind the wheel, or 2, they didn't think they had the opportunity to get the license, or 3, they don't want to pay the money. I don't know what it is, but it's like shocking. And I'm like, man, this is a huge opportunity. And I've even gone on like social media. I talk about it on my podcast all the time. There's still 1,000 left.
Really?
I don't get it. Yeah.
And so what's the criteria? You just have to have a property.
Mm-hmm.
apply for it,
Yep.
and they just say yes?
Yeah, it takes like 2 days.
That seems very weird.
I know.
Now I
We
want
do
one.
we do it all the time, and it's one per host, but I mean you can get creative, right?
Sure.
So if you have a spouse, then you could host one, and your spouse could host the other, or you can even use a property management company.
So pivoting to boutique hotels, because I have a lot of friends that do real estate, and you're the only friend of mine that has ever said I specialize in boutique hotels.
Sure.
I've heard short-term rentals. I've heard multifamily apartment complexes, storage units, trailer park homes, commercial real estate, retail, but never boutique hotels. What drew you to boutique hotels?
Couple things. So first, the multifamily space became more and more overheated. In 2021, we were underwriting deals, and a lot of these deals would have 45 property tours and like 30 offers. And the pricing guidance never made sense, and I would always circle back with these brokers to see what these deals traded for. And by the time they got to best and final, like these groups were overpaying big time. And these are the groups that are being foreclosed on right now. They were being way too aggressive with their assumptions. And unfortunately, they got in a little bit too late. And so that's overheated. And then on the short-term rental side, I love short-term rentals. We manage and operate a lot of them. Some of them we own. It's becoming overheated. There's been a big Airbnb boom over the last few years, especially with the pandemic. Rates were very low. Everyone was doing domestic travel. No one was traveling internationally. And so it kind of buffed up a lot of these numbers in a lot of these markets like Joshua Tree and Scottsdale. And so we're seeing an oversaturation in a lot of these markets from the Airbnb side, but also a lot of cities right now around the country are regulating. This has kind of been a new trending thing over the last 5 to 10 years. And so a lot of cities are like, well, we've never seen this before. We don't know how to approach it. And so a lot of cities, New York just basically banned short-term rentals.
I saw that.
Hard
like
stop.
New York City.
Hard stop. And so this is going to continue with all these markets around the country, most of them. And so as the regulations tighten on Airbnbs, it's going to bring more demand to hotels. But also all those Airbnb investors, if you talk to all of them will tell you they cannot wait to get into boutique hotels. It's the next natural progression for them. So if you can operate 4 or 5 Airbnbs, you already have the fundamentals to operate a boutique hotel. And so I thought about a year ago, I said, well, what if we make this pivot over? Multifamily's dried up, Airbnbs are becoming oversaturated. But I was like, if you marry the two of those, it's a boutique hotel. So I thought, what if we go and attack boutique hotels between 10 and 30 units, and we do a self-check-in, self-checkout model with the guests? One, it allows us to bring the manager's unit online for additional revenue, but it also allows us to eliminate the expense of having a manager on payroll. And so we use our property management company to self-manage and operate remotely. And we'll go in, we'll target tired, underperforming boutique hotels in great locations from mom and pop sellers. There's a lot of baby boomers that are retiring right now. A lot of these boomers own these boutique hotels. They've owned them for 30, 40 years. They have not renovated these properties in decades, and they're not implementing any marketing strategies. And so we'll put them on Airbnb, Vrbo, hotels.com, booking.com, and we'll do a lot of heavy social media marketing. And then we'll renovate these properties to a T. So we'll take them tired, and then we'll shut them down, do a full rental. We'll make them super nice. And we bought the first one a year ago. It was a 10-unit beachfront hotel. I said, let's see how this one goes.
In San Diego?
Up in Northern California in an area called Shelter Cove. The seller had owned it. It was a mom and pop seller, older gentleman. He'd owned it for 18 years. And he never did more than $180,000 in gross revenue. And he was relying on just an old crusty website. We bought it for 1.5, and he seller financed it. We put about $450,000 into a full renovation, and we just relaunched it. And this year we're going to take the revenue from 180 to 700. We bought it for 1.5 a year ago. It just appraised for 4.5.
Fantastic work.
And so we tripled the value in a environment with high interest rates.
Great job, man.
Thank you, man.
I want my money with you.
So that was kind of our test model. Let's see how it goes. And we're like, okay, I see the opportunity. No one's talking about it. I'm like, okay, we're going to go all in it before it becomes the next big thing.
So how do you find these mom and pops that may or may not want to sell or do want to sell? Because obviously once they list it, now you're subject to market conditions. But did you find this deal off market?
This deal was actually on LoopNet.
Okay.
So LoopNet is like your Zillow or Redfin, but for commercial real estate. And this deal was just sitting on LoopNet, and that's how we found that one. I would say 95% of the deals in the commercial space, even the boutique hotel space, are going to be controlled through a broker. And so I always tell people it's all about building the relationships with these brokers. The brokers control the deals because they're the ones that are spending decades building the relationships with these sellers, even if they are mom and pop. And so when they are ready to sell, they typically goes through a broker. And these brokers don't list a lot of their deals. A lot of them are pocket listings that actually never hit the market. And so they will go to their top buyer groups and then bring them the deals and the opportunities. So I always say build the relationships with the brokers, and that's the number one way to get the deal flow.
And so now that you killed it on your first boutique hotel, you launched a fund for boutique hotels?
Yes. So we launched the fund for the boutique hotels earlier this year.
So how does that work?
Yeah. So the fund is basically a way for the investors to be diversified across multiple assets. Up until this point, I've syndicated single assets. And so we would raise money from investors and we put it into one asset, one set of investors, one property. However, with this model, the investors are diversified. So it's a win for them. It's a little bit less risky for them. They don't have to pick and choose which deal is a good deal and which one's not. They can just put their money into the fund. They're diversified across multiple assets. But then from an operation standpoint, it's a lot easier on our end too, because now from a reporting standpoint, it's one set of investors to report to, all the properties. It's one set of distributions. It's one set of accounting, all that stuff. So it's a lot less operationally, and it's a better return on our time. The investors love it because they're diversified, so it's a win-win. Honestly, like looking back, I don't know if I'll ever go back to the single asset stuff anymore, you know?
Well, without this is not a sales pitch, but just because I'm curious, what are the parameters? So is there a minimum investment? What's the hold time? Obviously, you mentioned you focus on a 15 to 20% average rate of return. Is that the same in the fund? Kind of what's the thesis for the audience listening who's thinking, hey, I might want to participate in some boutique hotels?
Yeah, no, absolutely. I'm not going to get into the details because I'm going to keep it very, very like top line,
Sure.
just because of the basis. We're a 506B right now, but we're gonna be a C soon. But just the basis return profile, just very generally speaking, we target 15 to 20% annualized returns for the investors. We do quarterly distributions. This is across all of our offerings. And then for this one, it's a 10-year time horizon. So, 10-year projected hold period. We'll buy these assets, and sometime in year 3, once we add a lot of value, we'll look to refi the long-term debt, return some capital back to the investors. Then we'll cash flow these deals. We'll reap the tax benefits, and sometime by year 10, we'll look to exit for a nice gain. However, I always tell the investors if we can exit early and meet our 10-year projection, let's say early, like 7 or 8, for example, we'll look to exit early.
Do the investors get the tax benefits as well?
Yes, they all flow down to the investors, which is cool. So we'll get what's called cost segregation studies done on all of our properties. And it's a way to basically supercharge the depreciation of these assets. And so the investors will show a gain at the end of each year on their K1. However, they'll show a significant loss because of all the depreciation that is above and beyond that gain, which they can roll over from year to year, which is pretty cool.
Which, if you're listening and you're an entrepreneur and you're running your own business and you've been thinking about real estate, what Rich just talked about is what changed my whole perspective. Because once you get to the point where you're making money, you have to start thinking about tax strategies. And sometimes tax strategies for a lot of us, you go meet with an accountant and you find things to buy or places to invest. You don't want to lose money, but you want to lose money. And so by working in a syndicated fund like what Rich is offering, whether it's in boutique hotels or other opportunities, you are able, as long as they pass back down to you, you are able to watch your money actually grow. But as far as the IRS is concerned, that year you lost money, which allows you to offset that part of your loss against income you actually made, giving you more dry powder to invest in more deals on an annualized basis. So forgetting all the appreciation, forgetting the return you hope to get at the end, that right there is a huge thing to look into. So if you're sitting there with some extra money, you've been building good enterprise value in your current venture, start to look at strategic tax
Advantages.
Thank you. Advantages that you can start to deploy. And that's one of the things that I really love about your offering. And when we met at your place, it's like, hey, I don't have the time to manage boutique hotels.
Mm-hmm.
I don't have the time to learn this industry, but I want to own boutique hotels. So why wouldn't I want to put my money with you and a group like you, get the tax benefits now, let it grow over time, and then we'll deal with what we're going to do with all that taxable income later. Because obviously I want a lot of it at the end.
Yeah. No, absolutely. That's the name of the game. And I always tell people, people always ask me, like, hey, should I be active or passive? Well, it depends, right? So, if you are a business owner and that's the highest and best use of your time, which a lot of our investors, that is the case, or if you have a high-paying career, It's like, that's probably the best use of your time. Go invest passively with a good operator. There's many good operators out there. Find one that you resonate with and go invest passively. But on the flip side, if you aspire to be an active investor like I did when I was doing the air traffic, well, go learn the game. Go start networking, start getting into, different groups and start hanging out with other investors that are doing it actively and learn how to do it.
Mm-hmm.
And that's it. It all comes down to the time.
And there's one more thing I learned when we were at your office from Somers Capital, which is unique. You don't just take checks and I don't get to learn or understand anything, but you actually teach your investors as you are going. Can you elaborate on kind of how that works?
Yeah. So I always tell the investors that invest with us, like, if you have any strategic questions on how to grow your own personal portfolio or do any side deals, I'm always happy to jump on and help them in the process in any way I can. Very generous with our time. But in addition to that, we rolled out our boutique hotel investing mastermind in March of this year. And this is for the folks that want to be active, for the folks that have short-term rental experience and they're looking to take their game to the next level. We will basically teach them. We do two calls every week where we teach them basically how to source, raise capital, how to renovate and operate boutique hotels remotely. And so that's been really fun. We got a group of about 15 of us right now. And a lot of these guys and gals are crushing it. And just positive vibes. And it's fun to help others to buy real estate as well,
So where do you see yourself now with Somers Capital? You also have Fortune Cribs, which is more of your property management arm, and the mastermind. And I'm going to talk about your podcast because that's brand new for you.
It is.
But where do you see yourself in 5 or 10 years? Do you think you will continue down the boutique hotel side, or do you see other asset classes that inside of the real estate sphere, or not even without of it, outside of it, that are piquing your interest, or you're seeing that there might become an opportunity?
Yeah. I always say the 5 and 10 year thing's tough for me because I always feel like, what I think I want 5 years from now is going to be different when I get there. And if it's not different, that means I'm not growing. But I would say what we know we want to build a big thing with Somers Capital. And so we want to buy $1 billion worth of real estate. And with that, we're going to help a lot of our investors grow a lot of wealth, which is going to be cool. And then in addition to that, everyone on my team gets a slice of equity of all these deals we're buying because I don't want to do it alone, right? I want to help others win as well. But to answer your question, right now we see the opportunity as boutique hotels. And in 2-3 years from now, if the market shifts and let's say everyone's doing boutique hotels and no one's doing the Airbnb stuff anymore, maybe we pivot over. There might be another time, and I know there will be, to where we pivot over to other asset classes. Maybe we start buying multifamily again when the market shifts, and maybe, who knows, maybe we get into other asset classes that we don't even think of right now. But I can say, we are gonna build a big thing, and I'm a big believer in it's like those who pivot win, right?
Yep.
And so we're gonna take what the defense gives us.
Change ready.
Mm-hmm.
One of my core values as well.
Yeah, I love that.
So you launched the Rich Somers Report, your own show. I got to be a guest on it. Go check it out.
Mm-hmm.
Grant Cardone as well. What was the impetus for the show?
Yeah, so I had a podcast for 3 years with 2 old partners. We were the ones that were buying multifamily together. And about a year ago, decided to kind of split off because I just felt like I was not going to reach my full potential with the current structure. And so I decided to split off and do my own thing. But with that, I told the guys, I said, hey, you guys keep the podcast. We're still good friends, love those guys. But they kept the podcast, and I was like, I'm going to start my own and have the studio and that sort of thing. So I took everything I liked and I didn't like about that podcast and kind of made it my own. That one was all apartment investing. And after like 100 episodes, I was like, dude, I was bored about talking about apartments. And so I thought, man, if I'm getting bored, the listeners are probably getting bored too. So with this new one, it's real estate, business, wealth. Anyone that's aspiring or inspiring has a good story. They're self-made. I bring them on. So I brought on athletes, bring on a lot of entrepreneurs, a lot of real estate investors, and we just talk shop. But it's really fun. And when you came on, and man, it's the in-person thing is where it's at.
Mm-hmm.
Most people have the virtual thing, which is cool, but you're not really building a connection with someone when you log into a Zoom account, right? But in person, it's like we get to hang out, really get to know each other, and you never know from a networking standpoint, like where those relationships are going to take you to. And I just think the content is so much better, the sound quality and everything. But man, I love it. It's been fun. We're about 84 episodes in. We just implemented a 3rd episode recently. And so we do a Saturday episode now where we do Q&A with the listeners. And so we'll field questions throughout the week. We'll pick our top topics and questions, and we'll go deep on them on the Saturday episode and just try to provide as much value as we can. And then the other 2 episodes of the week, we bring on a guest.
I love it. I mean, I've been listening to your show since I've been a guest and got to meet you, and I think you provide a ton of value. You bring on really cool guests, have interesting conversations, so you definitely want to check that out. I do have to ask you one more question. What was your first tattoo?
First tattoo, I was 18 years old, and it was a 949 tattoo right here on my shoulder, which is the area code of where I grew up. I guess I'll have to explain that to my kids one day. I don't have kids yet, but one day I will. So that'll be kind of a funny story.
How many tattoos do you have?
I don't know. I have like 2 full sleeves, my chest done. It's actually funny. Like I haven't got any tattoos in like 5 or 6 years, but I'm actually going to meet with an artist downtown here soon. And I'm gonna get a bunch of work done. I'm gonna get like fully like redone, like everything. I'm just gonna roll with it.
Nice.
And I think when I first got into real estate investing, I was like, like I gotta like cover it up. But now I'm just kind of embracing it, and I'm gonna roll with it and just go all in now.
It's a reflection of who you are.
Mm-hmm.
Clearly. I mean, and I've been in your space, by the way. Your office is so fun. He's got some of the cool old arcade games. NBA Jam is down there, so
Yeah.
I gotta get a game against you some point.
Yeah.
But your staff you can feel the excitement and culture. And to your point about being live, getting to meet your team, I think it's so important as entrepreneurs, as leaders. It's great what you do, but you feel it when you're in your environment. I felt it with your staff. They believe in the bigger mission that you guys are after. You guys are changing the game in real estate. You're providing an on-ramp for a lot of us that don't yet understand how to participate actively, passively, etc. And you're actually doing it in a unique way. You're not just becoming a Me Too real estate investment arm that does the same thing everyone else does with maybe a little less experience or less resources. You're actually doing it in a boutique hotel. You picked a niche that is underserved. You guys are leading the space. You killed it with the first deal. I mean, clearly. You're doing a whole bunch of other deals. We're talking about me getting involved, wanting to participate as an investor. I'm just excited for everything you're doing. I'm glad we got to meet. I'm glad you invited me on your show so we even built this relationship. And Rich, dude, I want to thank you for coming on. I mean, our audience, we learned a lot from you today on real estate. For those that didn't know you before, definitely go follow Rich because he is absolutely a wealth of knowledge. He is so giving with his time and his expertise. So you can reach out to him, hit him up, take him on his word because he literally does it. He's here locally in San Diego. So when you come visit, definitely go check out his space. Anything else you want to leave for the audience, Rich?
Yeah, and I would just say life is short. So, make sure that, when you're making decisions, just remember life is short. And I think that's one thing I live by. I always say like months is the best way to measure how much time we have left. And so for me, when I struggle to make a decision, I think, okay, well, until average life expectancy age is 77, I literally have 468 months. That's crazy to think about.
When you say that, it doesn't feel very long.
No, it doesn't. And so once I learned that, I was like, man, I don't even have time to watch Netflix anymore,
There's no Netflix and chill.
There's no Netflix and chill, man. So I don't know. That's all I got to say. But, man, I appreciate you having me on, dude. Always good energy, good vibes, and I'm so fortunate to have connected with you, man. So excited to see where our relationship goes.
Well, thank you.
Hey everyone, first I want to thank all of you for tuning in. And if you guys haven't heard about my new book, Relationship Bank Account, click the link in the show notes or search the title on Amazon. This book is packed with all my secrets to success in both relationships and life. Make sure to pick up a copy, and if the book helps you on your journey, let us know by leaving a review. I appreciate all of you and can't wait to see you on the next one.